The official name for a solo 401k is the one participant 401k plan, but you might also hear people call it a solo K, uni-k, or one participant K. Oftentimes, a solo 401k will provide the highest savings potential for a self-employed individual. And it doesn't matter if your solo 401k is for a side business while you have another job working for another company. If you have any type of business, even a gig or maybe freelancing, and you want to save more on taxes now while putting more toward retirement, a solo 401k might be a great option. Basically, a solo 401k has the same requirements as a traditional 401k. There are specific reasons that you can make withdrawals from the plan. There are required minimum distributions and all the other things that go along with the 401k. There are no income restrictions and there are no age restrictions. The catch with a solo 401k is unless the employee is your spouse, you can't have any full-time employees. If you think that in the future you might have employees, or if it's possible that you will have part-time employees who might be allowed by law to participate in your retirement plan, then a solo 401k may not be a good fit for your business. I'm not providing any type of advice on whether you are allowed to establish a 401k or whether a solo 401k is right for your business. Please consult with your tax or financial advisor to see if a solo 401k is right for you. Now we're going to go over 4 reasons that the solo 401k has powerful potential. 1. Simplicity. First, making deposits to the plan is fairly simple. All you have to do is send the money from your business bank account over to your retirement plan account. One nice thing about a solo 401k is you don't have to make any type of minimum contribution. If you're not able to make a contribution in some years, you can simply skip making a contribution. Normally, 401k plans have to perform testing to make sure that there isn't discrimination in the plan in favor of owners or highly compensated employees. Since you don't have any employees, you don't have to perform the testing. One potential drawback of a solo 401k is having to file an additional annual return along with your federal tax return. The return would be filed on Form 5500EZ, but if your solo 401k plan has less than $250,000 in assets, you may be exempt from filing the return. The second reason that a solo 401k is powerful is employer contributions. Your business, as your employer, can contribute up to 25% of your compensation. If you're not being taxed as a corporation, you will have to do a special calculation to determine the maximum employer contribution you can make to the plan. Essentially, the special calculation reduces the maximum to 20%, but we will take a look at the calculation and an example in just a bit. In any case, though, your employer contribution does not have to be deposited until the due date of your business return. A corporation will deduct contributions on the business return, while other business types will deduct the contribution on Form 1040 Schedule 1. You will not deduct the contribution on your Schedule C. When I was an IRS auditor, I would see taxpayers including the contribution amount for the owner on Schedule C, and this would always lead to an audit adjustment. If you're planning on making solo 401k Roth contributions, you should deposit as much as you can of your pre-tax contributions as employer contributions. Employer contributions cannot be deposited into a Roth 401k, so you want to be able to have your employee contribution side available to put into your Roth solo 401k. This leads us to reason number 3, employee contributions. Like I just mentioned, you can't put employer contributions into a Roth. However, your employee contributions can be made to a Roth or on a tax-deferred or after-tax basis. Just to let you know, you will still pay FICA taxes even if you make your contributions on a tax-deferred basis. You can contribute up to 100% of your compensation with a maximum limit of $24,000 for 2024 and $22,500 for 2023, with an additional catch-up contribution of $7,500 if you're 50 or older. So just think, if you have a side business and you can afford to save $24,000 of your compensation from the business, you could build up a sizable nest egg fairly quickly. If your spouse is involved in the business, both of you or just one of you can contribute $24,000 each. Before you get too excited though, the contribution limits apply to all of your 401k plans. Please keep in mind that if you work for another company and participate in the company's 401k plan, you have to take into account the deferrals made to that plan as well. You can split your contributions across multiple plans, but your combined elective deferrals for your business and your employer's plan cannot exceed the contribution limit. Employer match contributions are not combined across plans though. So if you have an employer who will match your 401k contributions, you might want to max out the employer match before anything else. You don't want to pass up free money that your employer is handing out. So you should focus on at least putting in enough employee contributions to get the full match from that employer. So what is compensation? If you have a corporation, usually your W-2 wages are your compensation. You cannot include distributions in your compensation. And oh yeah, employee contributions have to be deposited right after a contribution is allotted on a paycheck, but definitely no later than the 15th business day of the following month. If you're not being taxed as a corporation, you don't have wages. So you can deposit your contribution by the due date of your federal tax return. And since you don't have wages, you will calculate a planned compensation amount as a substitute. Planned compensation is your net earnings from self-employment after deducting 1/2 of self-employment taxes and after deducting your solo 401k contribution. Reason 4, overall limit. With the solo 401k, tax-deferred contribution limits for solo owners are greater than under any other type of self-employed plan because you can start making catch-up contributions once you turn 50. Most self-employed plans don't allow catch-up contributions. For 2024, you can contribute a combined maximum total of $69,000 for your employer and employee portions. Plus, you can take an additional catch-up contribution of $7,500 if you're 50 or older. The total contribution limit for 2023 is $66,000. The limits usually increase every year. Also, the bank for your solo 401k may or may not keep track of your employer and employee contributions. So please be sure to keep track of employer and employee contributions separately on a spreadsheet or with any record-keeping system that you like. Now let's move on to the special calculation that you need to make in order to determine the amount you may contribute if your business is not taxed as a corporation. Here's an example using the limits for 2024. We will say that you are a sole proprietor and you are 39 years old. You had a business net profit of $200,000 before your solo 401k contribution, and your plan is set up for the maximum 25% employer contribution rate. We will take the contribution rate of 25% divided by the plan contribution rate plus 100%. So that's 25% divided by 125%. That gives us your reduced plan contribution rate of 0.2 or 20%. We can calculate your contribution by taking your net profit of $200,000 from line 31 on your Schedule C, and then we will subtract 1/2 of your self-employment tax deduction. Now we have $187,389. We multiply that by your reduced plan contribution rate to get an allowed employer contribution of $37,478. This contribution amount will go on Form 1040, Schedule 1. In our example, even if you make the maximum employee contribution, your total contributions won't go over the overall limit of $69,000 for 2024. By the way, if you are a high earner and you are planning on making catch-up contributions, starting in 2026, you will have to make your catch-up contributions to a Roth account. Please watch the video on the lower right of your screen if you want to hear more about it.